Before we begin our discussion on the topic marginal costing technique, here are some instructions to students or learners. Use headphone while listening to this lecture to have a clear and undisturbed listening. Please keep a notebook or paper and pen and a calculator to solve the problems alongside the process of viewing this video and also to note certain points. Students are advised to solve different problems from reference or textbooks on this subject based on this learning process because practice can make you more perfect with the concept. In case of any queries, students can contact on WhatsApp mobile number given in this video. Before we try to understand what marginal costing technique is all about, let's look into what are the objectives of this discussion. It is to understand first the techniques of costing, 2. The importance of marginal costing technique, 3. The importance of key factor in decision making, 4. The importance of cost volume profit analysis, and to equip students with the skill to be able to ascertain the marginal cost and solve case studies with the ability to make recommendations. Let's understand the techniques of costing. There are two techniques of costing. One, the absorption costing, and two, the marginal costing. Let's look into what absorption costing means. It's a conventional technique of ascertaining cost. It is the practice of charging all costs, both variable and fixed, to operations, processes, or products, and is also known as full costing technique. Under this technique of costing, cost is made up of direct costs plus overhead costs absorbed on some suitable basis. Under this technique, the cost per unit remains the same only when the level of output remains the same from time to time. But in practice, level of activity changes over time. Therefore, the cost also changes with the change in the level of activity, which poses a problem to the management in taking managerial decisions. Absorption costing technique is the oldest and the most widely used technique to ascertain cost, as it recognizes the importance of fixed cost, helps to show correct profits, and is recognized by various accountant bodies globally. Let's now try to understand what marginal costing means. It's the technique of ascertaining cost whereby only the variable cost of production are considered. The need for marginal costing technique arises from the fact that fixed expenses remain constant irrespective of the level of output, whereby fixed cost per unit varies with the level of output and so also the cost per unit, which makes it difficult to take some managerial decisions. On the contrary, the development of marginal technique excludes the fixed expenses entirely from the cost of production and gives us the same cost per unit for any level of activity subject to change in variable cost. Chartered Institute of Management Accountants UK defines the marginal cost as follows. Marginal cost is the amount at any given volume of output by which aggregate costs are changed if the volume of output is increased or decreased by 1 unit. In this context, 1 unit may be a single article, an order, a stage of production capacity, or a department. Let's understand this technique with the help of a simple example. Say for example, if variable costs per unit are rupees 10 and fixed expenses are rupees 1,50,000 per annum, an output of 30,000 units per annum results in the following expenditure. Variable cost 30,000 units into rupees 10 works out to 3 lakh rupees. Fixed costs 1,50,000, so the total cost would be 4,50,000. If the output is increased by 1 unit, the following expenditure will be incurred. that is variable cost for 30,001 units at the rate of rupees 10 works out to 3 lakh 10 rupees. Fixed cost 1 lakh 50,000, so the total cost works out to 4 lakh 50,000 10 rupees. The difference in expenditure for one additional unit works out to 10 rupees. This difference is termed as the marginal cost. Let's look into some of the features of marginal costing. First, it's a technique to ascertain the marginal cost and to know the impact of variable cost on the volume of output. 2. All costs are classified into fixed, variable, and semi-variable cost. 3. Variable costs are alone charged to production and fixed costs are recovered from contribution. 4. Valuation of work in progress and finished goods is done on the basis of marginal cost. 5. Selling price is based on marginal cost plus the profit. 6. Profit is calculated by deducting marginal cost and fixed cost from sales. And the cost volume profit, that is the BEP analysis, is one of the integral part of marginal costing. The scope of any study depends upon the application of the study in practice. So let's now look into the application of marginal costing technique in different areas. Marginal costing is a very useful tool in the hands of management because of its following application. The first one is cost control. As costs are divided into fixed and variable costs, the management can exercise control on the fixed costs to a limited extent, and the variable costs can be controlled at the lower level of management. Thus, under marginal costing, the concentration can be on variable cost control, in turn helping to control overall costs. Second is profit planning. Marginal costing helps in profit planning, that is, planning for future operations in such a way as to maximize the profit or to maintain a specified level of profit by exercising strict control on variable costs. Third, evaluation of performance. Different products, departments, markets, and sales division have different profit earning capacities. Marginal cost analysis is a very useful tool in evaluating the performance of each sector of a concern, as distinction is made between fixed and variable cost. The fourth one is decision making. Mere cost information is insufficient in solving problems of the management. Marginal costing technique provides assistance to management in vital decision making, especially in dealing with problems requiring short-term decisions where fixed costs are excluded. Important areas where managerial problems are simplified by marginal costing, namely fixation of selling price, key or limiting factor, make or buy decisions, selection of suitable product mix, effect of change in price, maintaining desired level of profit, alternative methods of production, diversification of products, closing down or suspending activities or production, alternative course of action, and purchasing or leasing decisions. After we have analyzed the areas of application of marginal costing technique, let's look into the cost volume profit analysis. Cost volume profit analysis is also known as break-even point analysis. Earning maximum profits is the ultimate goal of almost all business undertakings. The most important factor influencing the earning of profit is the level of production or the volume or output. Cost volume profit analysis examines the relationship of costs and profit to the volume of business to maximize profits. In a narrow sense, the cost volume profit analysis is concerned with finding out the crisis point, which we may also call as break-even point. This is the level of activity or volume or output where the total revenue is equal to the total cost. It is also in general called as no profit, no loss point. But in a broader sense, cost volume profit analysis is concerned with determining the profit, cost and sales value at different levels of output. After we have understood what cost volume profit analysis means, let's now look into the objectives of cost volume profit analysis. We may also call it as trying to understand the advantages of cost volume profit analysis. The first objective is the analysis helps to forecast profit fairly accurately. 2. The analysis is useful in setting up flexible budgets. 3. It assists in performance evaluation for the purpose of control. 4. It assists in formulating price policies. 5. It helps to know the amount of overhead costs to be charged to the product cost at various levels of operation. The study of cost volume profit analysis can be made in two ways. First, understanding the mathematical relationship between cost, volume and profit. 2. By the preparation of break-even charts. Mathematical relationship between cost, volume and profit requires the understanding of marginal cost equations. Let's analyze the marginal cost equations. Let's put up the first equation. Sales is equals to variable cost plus fixed cost plus profit, which can also be rewritten as sales minus variable cost is equals to fixed cost plus profit. Generally, we may use alphabets or the acronyms to write these equations, whereby this equation can also be written as S minus VC is equals to FC plus P, where S represents sales, VC is variable cost, FC fixed cost and P represents profit. Now this equation can further be written as sales minus variable cost is equals to contribution. Thus, contribution is equals to fixed cost plus profit. Or we can also write this as contribution minus fixed cost is equals to profit or loss. Thus, it's clear that to earn a profit, the contribution should be greater than the fixed cost. And the break-even point, the contribution is equals to fixed cost, that is no profit or no loss point, whereby we write the equation as contribution is equals to fixed cost under BEP. Let's now look into the application of the marginal cost equations to find out the missing variable. Let's look into this illustration to apply the same. Determine the amount of fixed expenses from the following particulars. Sales rupees 2,40,000, direct materials rupees 80,000, direct labor rupees 50,000, variable overheads rupees 20,000 and profit rupees 50,000. Let's put up the marginal cost equation. That is sales minus variable cost is equals to fixed cost plus profit. Let's put in the given variable figures to this equation. So sales is 2,40,000 minus variable cost 1,50,000. That is direct materials 80,000, direct labor 50,000 and variable overheads 20,000, which sums to 1,50,000. That's equals to fixed cost, which is an unknown variable, plus 50,000. So when we work out, we get fixed cost is equals to 90,000 minus 50,000. Therefore, fixed cost is equals to rupees 40,000. Students should note here that depending on the information or particulars available, the marginal cost equation can be used to find the unknown variable. In order to understand the mathematical relationship between cost, volume, and profit, it is desirable to understand the following concepts, their calculations and applications. The first one is contribution. 2. The PV ratio, that is contribution upon sales ratio or the profit volume ratio. 3. Break-even point. 4. Margin of safety. Let's try to understand in specific what contribution means, though we have looked into what contribution constitutes. Now, if we define contribution, we define it as the difference between the sales and the marginal cost of sales. That is variable cost, and it contributes towards the fixed expenses and profits. Therefore, the equation what we had earlier cited, that is contribution is equals to sales minus variable cost, or it can also be written as contribution is equals to fixed cost plus profit. Now let's take an example to understand how we arrive at this contribution. Say for example, if selling price of a product per unit is rupees 20 and the variable cost is rupees 10, then the contribution will be rupees 10. That is sales minus variable cost is equals to contribution. That is 20 minus 10, that's equals to rupees 10. The next concept is the profit volume ratio or the PV ratio. It's an important ratio which establishes the relationship between contribution and sales. The ratio is expressed as follows. PV ratio is equals to contribution divided by sales, or it's also rewritten as PV ratio is equals to fixed cost plus profit divided by sales, or PV ratio is equals to sales minus variable cost divided by sales, or PV ratio is also calculated by the two variables, that is change in profits divided by change in sales. For example, if the selling price of a product per unit is rupees 15 and the variable cost is rupees 10, then we calculate the PV ratio as under. Based on the variables that are given, we make use of the equation, that is PV ratio is equals to contribution upon sales. So we can also rewrite this now as PV ratio is equals to sales minus variable cost divided by sales. That's sales here is 15 rupees per unit minus variable cost per unit is 10. So 15 minus 10 divided by the sales per unit, that is 15 rupees. So this gives us the PV ratio as 1 upon 3, or it's 0.33. This ratio in this example indicates that the proportion of profit to turnover is 1/3 or 33 1/3%. Let's look into another illustration to calculate the PV ratio from the following information. Situation A, given selling price rupees 10 per unit and the variable cost per unit rupees 6. Situation 2, given the profits and sales of two periods as under. 2001 sales rupees 1,50,000, profits rupees 20,000. 2002 sales 1,70,000, profit rupees 25,000. So based on the information given in situation 1, let's put up the equation PV ratio is equals to contribution upon sales, which can also be written as sales minus variable cost divided by sales, because contribution is equals to sales minus variable cost. Let's put in the values over here. So sales is 10 rupees per unit, variable cost is 6 rupees per unit divided by sales, that is 10 rupees. So we get 4 upon 10, that is rupees 4 divided by 10 into 100 to convert it into percentage. So the PV ratio would be 40%. You can also write it as 2 upon 5 also. Let's look into the second situation where the profits and sales of two periods are given. So based on this information, we take up the equation or write the equation. PV ratio is equals to change in profits divided by change in sales. So it is 25,000 minus 20,000 divided by 1,70,000 minus 1,50,000. So that works out to 5,000 divided by 20,000 multiplied by 100 to convert into percentage. So the PV ratio would be 25%. The next concept is the break-even point. A business is said to break even when its total sales revenue is equal to its total costs. It's also called as a no profit or no loss point. At this point, the contribution is equal to fixed cost. Any firm would like to know the break-even point of its sales because it's only after reaching this level of activity or sales that an organization starts earning profit. Therefore, the break-even point is calculated as under. Break-even point can be calculated both in units and in value. Now, to calculate it in units, the break-even point equation is total fixed costs divided by contribution per unit. Whereas, in case of break-even point calculation in sales, the total fixed costs are divided by the PV ratio. Let's take up an illustration to practice the computation of contribution and the break-even point in units and sales. Let's look into this illustration. From the following particulars, calculate contribution, PV ratio, break-even point in units and value, and also calculate what will be the selling price per unit if the break-even point is brought down to 25,000 units. Fixed expenses rupees 1,50,000 and the variable cost per unit is rupees 10. Selling price per unit is rupees 15. Let's try to calculate the different variables from the given information. So let's begin with first contribution. Now contribution is equals to selling price per unit minus variable cost per unit. So in this particular case, the selling price per unit is rupees 15 and the variable cost per unit is 10. Therefore, the contribution works out to rupees 5. The second one is computation of the PV ratio. So PV ratio is equals to contribution upon sales. So here the contribution per unit is 5 and the selling price per unit is 15. Therefore, 5 upon 15 works out to 1 upon 3, or in terms of percentage, it works out to 33.33%. The third one is calculating the BEP in units. So the equation is fixed costs upon contribution per unit. So the fixed cost here is 1,50,000 and the contribution per unit is rupees 5. Therefore, the BEP in units works out to 30,000 units. So the firm here reaches break-even point at a activity level of 30,000 units. Now in terms of value, we can multiply the break-even units into the selling price to get that value. But in terms of equation, the BEP is calculated as fixed cost upon PV ratio. So the fixed cost is 1,50,000 divided by 1 upon 3 or 33.33%. Therefore, it works out to 4,50,000 rupees. Let's now try to calculate the selling price per unit if the break-even point is brought down to 25,000 units. Let's put up the equation. Break-even point in units is equals to fixed cost divided by contribution per unit. So this equation can be rewritten as fixed cost divided by sales minus variable cost. So when we put up the variables, we get 25,000 is equals to 1,50,000 divided by sales, the missing figure, minus the variable cost, rupees 10 per unit. So when we substitute this equation, we get 25,000 into sales minus 2,50,000, that's equals to 1,50,000. Therefore, sales is equals to 1,50,000 plus 2,50,000 divided by 25,000. Therefore, sales is equals to 4 lakh divided by 25,000. That gives us rupees 16 per unit. That is the selling price at new break-even point. There's an alternative method to calculate the selling price per unit by calculating the contribution per unit at new break-even point. That is fixed cost divided by break-even point in units, which is equals to 1,50,000 divided by 25,000, which gives us rupees 6 as the contribution per unit. Therefore, selling price is equals to variable cost plus contribution, that is rupees 10 plus rupees 6, which sums to rupees 16 per unit. That is the selling price per unit at new break-even point. Students can adopt either of the method to calculate the selling price at a particular break-even point. The next concept under cost volume profit analysis is the study of margin of safety. Now, margin of safety is the difference between the actual sales and the sales at break-even point. Margin of safety is also defined as the excess production over break-even point. This excess sales over break-even point is called margin of safety because it gives some profit once the fixed costs are recovered at break-even point. Margin of safety is calculated in following ways. One is margin of safety is equals to actual sales minus break-even sales. It's also calculated by the equation profit divided by PV ratio. Third, margin of safety in units can be calculated as profit divided by contribution per unit. Let's practice the concepts and their calculation with the help of an illustration. Let's look into the illustration over here. A company has fixed expenses of rupees 90,000 with sales at rupees 3 lakh and a profit of rupees 60,000 during the first half year. If in the next half year the company suffered a loss of rupees 30,000, calculate PV ratio, break-even point and margin of safety for the first half year. 2. Expected sales volume for the next half year, assuming that selling price and fixed expenses remain unchanged. Third, the break-even point and margin of safety for the whole year. Now, let's try to calculate the necessary variables from the given information. Now, here the information is split into two halves, the first half of the year and the second half of the year. And we have been asked to calculate the PV ratio, break-even point and margin of safety for the first half year and an expected sales in the next half year, and also the break-even point and margin of safety for the whole year. Let's take up the first question. So let's calculate the PV ratio, that's equals to contribution divided by sales, and we multiply it by 100 to convert it into percentage. Therefore, fixed cost plus profit divided by sales into 100. So fixed cost given to us is 90,000 plus profit for the first half is 60,000 divided by sales in the first half of the year, that is 3 lakh, into 100 to convert into percentage. So that's equals to 1,50,000 divided by 3 lakh into 100. That's equals to 50%. So the PV ratio is 50% in the first half. Break-even sales is equals to fixed cost divided by PV ratio. So therefore, 90,000 divided by 50% gives us rupees 1,80,000. So in the first half of the year, the break-even sales is 1,80,000. Let's calculate the margin of safety. That's equals to actual sales minus break-even sales for the first half. So sales for the first half is 3 lakhs minus the break-even sales, that is 1,80,000. So that works to 1,20,000 rupees. Now let's answer the second question, that is calculating the expected sales volume in the second half year where there is a loss. So the equation would be fixed cost minus loss divided by PV ratio. That's equals to fixed cost is 90,000 minus 30,000 divided by 50%. That is equals to 60,000 divided by 0.50, which works out to rupees 1,20,000. The third question is about calculating the break-even point for the whole year. So the equation is fixed cost divided by PV ratio. That's equals to 90,000 plus 90,000. So 90,000 is the fixed cost in the first half of the year and 90,000 is the fixed cost in the second half of the year divided by 50%. Therefore, the total fixed cost for the year is 1,80,000 divided by 0.50. That works out to rupees 3,60,000. The margin of safety for the whole year therefore would be actual sales minus break-even sales. So the actual sales for the whole year is 3 lakh rupees in the first half and 1,20,000 as calculated earlier in the second half minus 3,60,000. So that works to 4,20,000 minus 3,60,000. That's equals to rupees 60,000. Let's try to practice the concepts with the help of another illustration. So let's go through the illustration here. A company has annual fixed costs of rupees 14 lakh. In 2012, sales amounted to rupees 60 lakh as compared with the sales in 2011 at 45 lakh rupees, and profit in 2012 was rupees 4 lakh 20,000 higher than in 2011. So calculate at what level of sales does the company break even? 2. Determine the profit or loss on present sales volume of rupees 80 lakhs. And third, if there is a reduction in selling price in 2013 by 10% and the company desires to earn the same profit as in 2012, what would be the required sales volume? So here in this particular problem, we have been given the comparative sales of two periods, that is 2011 and 2012. And at the same time, it is stated that the profit in 2012 was rupees 4,20,000 higher than in 2011. So the difference in profits is 4,20,000. And we have been asked to calculate with the help of these variables the company's break-even point and to determine the profit or loss at the present sales volume of rupees 80 lakhs, and also to calculate what sales would be required if there is a reduction in the selling price by 10% in 2013 and the company earns or desires to earn the same profit as in 2012. So let's first calculate the break-even point or the break-even sales. So the equation is PV ratio is equals to change in profit divided by change in sales. Now we use this equation based on the information that's available, multiplied by 100, that's to convert it into percentage. So the change in profit is 4,20,000 divided by change in sales is 15 lakh, that is 60 lakhs minus 45 lakhs into 100. So that works to 28%. Now the break-even point is equals to fixed cost divided by PV ratio. So fixed cost is 14 lakhs as stated divided by 28%, that is 14 lakhs divided by 0.28. That gives us rupees 50 lakhs as the break-even point or the break-even sales. Let's now answer the second question, that is calculation of profit at present sales volume of rupees 80 lakhs. Let's take up the equation. PV ratio is equals to contribution upon sales, which is rewritten as contribution is equals to sales multiplied by PV ratio. So contribution is fixed cost plus profit is equals to sales into PV ratio. So therefore profit is equals to sales into PV ratio minus fixed costs. So let's put up the variables here. Profit is equals to 80 lakhs into 0.28 minus 14 lakhs. That gives us a profit of rupees 8 lakh 40,000 rupees. Now let's calculate or answer the third question, that is calculation of sales volume when there is a reduction in selling price by 10% and the company is expected to earn the same profit as earned in 2012. So let's take up the contribution that is earned in 2012, that is 28% of rupees 60 lakh, that works out to 16 lakh 80,000 rupees. Now the sales volume in 2013 after a 10% reduction from the 2012 sales works out to 54 lakh rupees, that is 60 lakhs minus 10% reduction 6 lakh, which is 54 lakhs. The contribution would be 16 lakh 80,000 as in 2012 with a reduction of 10%, that works out to 10 lakh 80,000 rupees. Therefore, we calculate the PV ratio is equals to contribution divided by sales into 100 to convert it into percentage. Therefore, we get it as 10 lakh 80,000 divided by 54 lakh into 100, that works out to 20%. So, to earn the same percentage of profit as in 2012, the expected sales is calculated as expected sales is equals to contribution divided by PV ratio. So here the contribution is 16 lakh 80,000 divided by 0.20, that gives us a sales volume of 84 lakh rupees. Let's take up another illustration. The following figures for profit and sales are obtained from the accounts of Sweetheart Limited. So let's look into the variables. In 2016, the sales is 40,000 and profit 4,000. In 2017, the sales is 60,000 rupees and profit rupees 8,000. Now we are asked to calculate 1. PV ratio, 2. Fixed cost, 3. Break-even sales, 4. Profit at sales of rupees 95,000 and sales to earn a profit of rupees 9,000. So let's take up first the calculation of PV ratio. So PV ratio is equals to change in profit divided by change in sales into 100. Now based on the variables given, we have used this particular equation. So now let's put up the amounts over here. So change in profit is 4,000, that is 8,000 minus 4,000, and change in sales is 60,000 minus 40,000, that is 20,000 into 100. So the PV ratio works out to 20%. Let's calculate the fixed costs with the help of this equation, that is sales is equals to fixed cost plus profits divided by PV ratio. So the sales is 40,000, that's equals to fixed cost, which is an unknown figure to be calculated, plus profits 4,000 divided by 0.20. Here we have taken the variables from the year 2016. You can also take the variables from 2017, which will give you the same amount of fixed cost, because fixed costs would remain fixed over a period of time unless there is any change in the level of activities substantially. So that works out to 8,000 is equals to fixed cost plus 4,000. So fixed cost is equals to 8,000 minus 4,000. So that's therefore fixed cost is equals to rupees 4,000. Let's now calculate the break-even sales. So break-even sales is equals to fixed cost divided by PV ratio. That's equals to 4,000 divided by 0.20. That works out to rupees 20,000. So the break-even sales is rupees 20,000. Let's calculate the profit at sales of rupees 95,000. So the equation we put up is sales is equals to fixed cost plus profits divided by PV ratio. So the sales is 95,000, expected sales we call it as, is equals to fixed cost 4,000 plus profit that is to be ascertained divided by 0.20. Therefore, 95,000 into 0.20 is equals to 4,000 plus profit. Therefore, 19,000 is equals to 4,000 plus profit. So profit is equals to 19,000 minus 4,000 after equating the variables, which gives us a profit of rupees 15,000. Let's try to find out the sales to earn a profit of rupees 9,000. So let's put up the equation. Sales is equals to fixed cost plus profits divided by PV ratio. That's equals to 4,000, that's the fixed cost, plus 9,000 expected profit divided by PV ratio, that is 0.20. That's equals to 13,000 divided by 0.20, which gives us a sales figure of rupees 65,000. Therefore, to earn a profit of 9,000, the company is expected to have a sales of rupees 65,000. Let's look into one more application area of marginal costing, that is decision making based on key factor analysis. Let's try to understand what is key factor or limiting factor. A key factor is that factor which puts a limit on production or profit of a business. Usually, the limiting factor is sales. A concern may not be able to sell as much as it can produce. Sometimes a concern can sell all it produces, but production is limited due to the shortage of materials, labor, plant capacity, or capital. In such cases, a decision has to be taken regarding the choice of the product whose production is to be increased or reduced or sometimes stopped. Normally, the choice of the product will be based on the highest PV ratio. Say for example, materials are limited in supply and products X and Y use the same materials. 3 units of materials are used for producing product X and 5 units for product Y. Suppose further contribution per unit is rupees 12 in case of product X and rupees 15 in case of product Y. So in this case, the contribution of product X would be 12 rupees divided by 3 units, that's equals to rupees 4 per unit of material. Whereas contribution of product Y would be 15 rupees divided by 5 units, that's equals to rupees 3 per unit of material. Hence, the available material should be first used to produce product X because it contributes to more profit per unit of material consumption. Let's take up an illustration when different key factors are involved in decision making and how a company would take decisions under different circumstances. Let's look into the illustration here. The following particulars are extracted from the records of a company. Now the particulars given for the two products produced, product A and product B, are sales price rupees 100 and rupees 110 respectively. Consumption of material in terms of kgs, for product A it's 5 and product B it's 4 kgs. Material cost, for product A it's rupees 24 and product B rupees 14. Direct wages rupees 2 and rupees 3 respectively. Machine hours used 2 hours for product A and 3 hours for product B. Value of variable overheads rupees 4 and rupees 6 respectively. Comment on the profitability of each product, that is both use the same raw material when total sales potential in units is limited, 2. Total sales potential in value is limited. 3. Raw material is in short supply. 4. Production capacity is the limiting factor in terms of machine hours. Let's prepare a statement to show the calculation of contribution per unit for product A and product B. So let's have the statement ruled out here with particulars column, product A and product B column, where the cost per unit would be shown. Now let's take the sales price per unit, that is rupees 100 in case of product A and rupees 110 in case of product B. Let's deduct the variable cost to arrive at the contribution. So less variable cost, which comprises of material, labor and overhead costs, that is 30 rupees in case of A and 23 rupees in case of B respectively. Now this amount is calculated by adding up the cost of materials, wages and variable overheads. In case of product A, material is 24 rupees, wages 2 rupees and variable overheads 4 rupees, summing up to 30 rupees. In case of product B, material consumed is 14 rupees, wages 3 rupees and variable overheads 6 rupees, summing up to a total of 23 rupees. Now when this variable cost is deducted from the sales price, we arrive at a contribution of rupees 70 in case of product A and 87 rupees in case of product B. Now contribution per rupee of sales, that's the PV ratio, would be 70 paise in case of product A and 79 paise in case of product B. Contribution per kg of material calculated by dividing the contribution by the number of units of material consumed would give us a contribution per kg of material of rupees 14 in case of product A and 21 rupees 75 paise in case of product B. Contribution per machine hour in case of product A is 35 and in case of product B is 29, which is calculated by dividing contribution by the number of machine hours consumed by each product. Now let's comment on the different limiting factors and decide upon which product should be produced. Let's take up the first one. When total sales potential in units is the limiting factor, then product B should be produced because its contribution per unit is more by rupees 17 than product A, that is 87 rupees minus 70 rupees. Second, when total sales potential in value is the limiting factor, then product B should be produced because its contribution per rupee is more by 9 paise than product A, that is 79 paise minus 70 paise. The third one, when raw material is in short supply, product B should be produced because contribution per kg of raw material is more by 7 rupees 75 paise than product A, that is 21 rupees 75 paise minus 14 rupees. When production capacity is the limiting factor, product A should be preferred over product B because contribution per machine hour is more by rupees 6 than product B. Overall, if we look into, product B would be more preferred to be produced because the contribution is more in comparison to product A with regard to different limiting factors. Let's take up an illustration with make or buy decision. Let's go through the contents of the illustration. A firm can purchase a spare part from an outside source at rupees 11 per unit. There is a proposal that the spare part be produced in the factory itself. For this purpose, a machine costing rupees 1 lakh with annual capacity of 20,000 units and a life of 10 years will be required. A foreman with a monthly salary of rupees 500 will have to be engaged. Material required will be rupees 4 per unit and wages rupees 2 per unit. Variable overheads are 150% of direct labor. The firm can easily raise funds at 10% per annum. Advise the firm whether the proposal should be accepted. Let's analyze this problem and try to find out whether the company should produce or should buy from outside source. Now let's look into the fixed costs incurred in case of production. Now depreciation on machine per annum would work out to 10,000 rupees. Salary of foreman at the rate of rupees 500 per month would work out to rupees 6,000 per annum. The interest on capital for the fund raised at 10% per annum would work out to rupees 10,000. So the total fixed cost that would be incurred if the company produces this particular spare part. Now the marginal cost per unit that would be incurred in the production of spare parts are material rupees 4 per unit, wages rupees 2 per unit, and overheads at 150% of wages, that is 3 rupees per unit. So the total marginal cost that would be incurred is rupees 9 per unit. Let's calculate the contribution per unit of output now. Purchase price, that's the market price of the spare part, is rupees 11. Less the marginal cost estimated would be 9 rupees. Therefore, the contribution per unit would be rupees 2. Let us now ascertain the break-even point to know what should be the level of production of the spare parts to recover the additional fixed cost expenses. So, BEP in units is equals to fixed cost divided by contribution per unit. So here it would be 26,000, that's the fixed expenses, divided by rupees 2 contribution per unit. So the BEP would work out to 13,000 units. The BEP point indicates that the company can recover its fixed expenses only if it can produce 13,000 units and consume the same in its organization. Let's comment on the decision to be taken. Now the firm should accept the proposal on following grounds. First, the company has a marginal cost of production of rupees 9, which is much lower than the market price at which it is available. Therefore, the company can manufacture or should manufacture the product, that is the spare part. 2. The company should consider the production beyond the BEP point so as to recover the additional fixed costs that would be incurred in the production of this spare part. Let's look into an illustration with a product mix decision. The following details relate to the manufacture of two products P and Q. Now the details are given below. Direct materials in case of product P rupees 12 and product Q is rupees 18 for the respective materials consumed in terms of units. Direct wages per unit is rupees 4 in case of both P and Q. Selling price per unit is rupees 30 in case of product P and rupees 40 in case of product Q. Variable overheads are to be charged at 100% of direct wages. Fixed costs rupees 1,20,000. Now we have to calculate the PV ratio for each product. 2. State which product is preferable if material is in short supply. 3. State which of the following sales mix will you recommend and why. Now the first sales mix involves production of 14,000 units of product P and 6,000 units of product Q. Sales mix 2 is 10,000 of product P and 10,000 of product Q respectively, and sales mix 3 is 8,000 units of product P and 12,000 units of product Q respectively. Let's prepare a statement showing calculation of contribution and PV ratio for the two products, product P and product Q. Let's rule out a statement with particulars column, product P column and product Q column. Now the selling price is 30 rupees and 40 rupees respectively in case of product P and product Q. Now, we deduct the variable costs from the sales price. So, the variable costs are direct materials rupees 12 in case of product P and rupees 18 in case of product Q. Direct wages is 4 rupees for product P and 4 rupees for product Q. Variable overheads are 10% of wages, which works out to 4 rupees in both the cases. So the total variable cost would amount to 20 rupees in case of product P and 26 rupees in case of product Q. So the contribution would be sales minus variable cost, that is rupees 10 in case of product P and 14 rupees in case of product Q. So let's calculate the PV ratio now. So PV ratio is equals to contribution upon sales. Therefore, in case of product P, it would be 10 divided by 30 rupees, that's equals to 0.33. And in case of product Q, it would be 14 divided by 40, that's equals to 0.35, which can also be expressed as 33.33% in case of product P and 35% in case of product Q. Now, contribution per kg of raw material is calculated as total contribution divided by material consumed, that is 10 divided by 2 kgs in case of product P, and in case of product Q it would be 14 rupees divided by 3 kgs. Therefore, the contribution per kg of material would be rupees 5 and rupees 4.67, that is 4 rupees 67 paise. Now let's comment on the computations made. Based on the contribution per kg of material used, it is recommended to produce product P when material shortage is the key factor, because the contribution is more by 33 paise in comparison to product Q. Let's rule out a statement showing calculation of contribution and profit for the sales mix. So let's rule out a statement with the particulars column, sales mix column, that is sales mix 1, sales mix 2 and sales mix 3 column. Now let's calculate the contribution for these sales mix. For product P at the rate of rupees 10 per unit, it works out to 1,40,000 for sales mix 1, that is 14,000 units into 10 rupees. Similarly, for sales mix 2, it is 10,000 into 10 rupees, that is 1 lakh. And for sales mix 3, it is 8,000 into 10 rupees per unit, that is 80,000. For product Q, at the rate of rupees 14 per unit, it works out to 84,000 for sales mix 1, that is 6,000 into 14 rupees per unit. And in sales mix 2, it is 10,000 units into rupees 14 per unit. And in sales mix 3, it is 12,000 units into 14, that is 1,68,000. So the total contribution works out to sales mix 1 2,24,000, sales mix 2 2,40,000 and sales mix 3 2,48,000. Now from this we deduct the fixed cost, that is 1,20,000 in each of these sales mix. Therefore, the profit that is arrived at after deducting the fixed cost from the total cost works out to 1,04,000 in case of sales mix 1, 1,20,000 in case of sales mix 2 and 1,28,000 in case of sales mix 3. Now based on the profits earned in these three sales mix, let's comment on to the profitability of each of these sales mix. Now based on the profit earned by each sales mix, we can recommend the sales mix 3 as ideal because it gives the maximum profit in comparison to other sales mix. Let's look into another illustration wherein the cost volume profit analysis can be studied with the help of a break-even chart method. Now from the following data, calculate break-even point and profit if output is 50,000 units by drawing a break-even chart. Now the data has been classified and given to us in the form of a chart where the production in units, the fixed cost, the variable cost per unit, the selling price per unit is given to us. Now based on this, the total cost and the total sales are calculated. Now at 0% or 0 level of output, the fixed cost incurred is 1,50,000. With no variable costs incurred, the total cost would be 1,50,000, and at this level there is no sales revenue. At 10,000 units, the total cost is arrived at 2,50,000, that is 1,50,000 fixed cost and 1 lakh variable cost at 10 rupees per unit, and the total sales revenue is 1,50,000 at a selling price of rupees 15 per unit. Now similarly, for 20,000 units produced, the total cost is 3,50,000 and the total sales revenue is 3 lakh rupees. So here, in all these cases, the total sales revenue is less than the total cost, whereby the company is incurring a loss. At 30,000 units, the total cost is 4,50,000 and the total sales revenue is also 4,50,000, indicating that this is a point where the company breaks even, where its total revenue is equals to total cost, where no profit or no loss situation arises. At 40,000 units, the total cost is 5,50,000 and the total revenue is 6 lakh rupees. Here, the revenue is greater than the cost, whereby the company is earning a profit of 50,000 rupees. Similarly, at 50,000 units, the total cost works out to 6,50,000 and the total sales revenue works out to 7,50,000, giving a profit of 1 lakh rupees. At 60,000 units, the total cost is 7,50,000 and total sales revenue is 9 lakh, whereby the company is earning a profit of 1,50,000 rupees. Now, let's put up this data in the form of a chart and draw a break-even chart to show how the break-even point is calculated when the total sales revenue cuts the total cost curve, and also how the profit at an output of 50,000 units or at any level of units can be calculated with the help of a break-even chart. Let's rule out the break-even chart. So we draw the OX axis horizontally and the OY axis vertically. On the OX axis, let's plot the output in terms of units, that is 10,000 units, 20,000, 30,000, 40,000, 50,000 and 60,000. On the OY axis, we plot the cost and revenue in lakh rupees, that is 1 lakh, 2 lakh, 3 lakhs, 4 lakhs, 5 lakhs, 6 lakhs, 7 lakhs, 8 lakhs, 9 lakhs and 10 lakhs. We rule out the fixed cost curve at 1,50,000 rupees. Now we plot the total costs and draw the total cost curve. Then we draw the total sales revenue curve with the help of the variables plotted on the graph. Now the total cost curve cuts the total sales curve at 30,000 units at a break-even sales of 4,50,000 rupees. We call this intersection point as the break-even point. And at 50,000 units, at a sales of 7,50,000 rupees, we can calculate the profit earned by the company, that is 1 lakh rupees, where the sales value is 7,50,000 and the cost is 6,50,000, giving a profit of 1 lakh rupees. So the data is plotted on the graph to draw the curves respectively. Now from the graph we can ascertain that the break-even point is 4,50,000 rupees at 30,000 units. So break-even point in value is 4,50,000 and in terms of units it is 30,000, and the profit earned at 50,000 units is rupees 1 lakh. So this is how a break-even chart can also be used as a tool to understand or have the cost volume profit analysis. Now, what is expected from the students out of this discussion is the outcome of this study. So, the expected outcome of the study is that the learners should be able to apply the technique of marginal costing in analyzing the case studies and making recommendations. The learner should understand that marginal costing is a technique which needs to be applied to situations to find answers and to take managerial decisions for implementation of recommendations. Third, to understand that marginal costing technique is applied in taking decisions whenever overseas orders are to be accepted at a very competitive price. Fourth, to understand that how with the help of this technique of costing, industries make the best use of their unutilized capacity in combating the competition in a very volatile and uncertain market conditions. Students should note that they should practice several case studies because each situation requires a different approach to the application of marginal costing technique. Thank you, and I hope you had a nice learning experience.